And maybe you heard that the session is being recorded. My name is Elena Rogers. I'm the Business Development Manager here at Key Point Credit Union. And before I introduce Jimmy, I just wanted to go over a little bit of housekeeping with you. For those of you that are members already, we do have a great refer a friend bonus that you can find out about on our website. And then for those of you that may not be Key Point members yet, we do have a great new member promotion right now where you can earn up to $300. So make sure you check that out. Jimmy's presentation today, Investing 101. He's got quite a few slides to go over, so we'll probably last about 45 minutes. He'll answer some questions during the presentation, but we'll have plenty of time at the end as well to address any questions. If at any time during his presentation you do have a question, please, if you could just input those into the Q&A as opposed to the chat, that would be great so we can keep them in one bucket, so to speak. And then let's see, what else? We are not providing the slide deck for today's presentation. Jimmy's happy to work with you afterwards, answer any questions. Like I said, the session is being recorded. So once it is ready, it will be posted for you to go back and view. We do have some other webinars from our wealth management team as well that are available. So we can add that link later in the chat for you all. With that, I wanted to introduce Jimmy Suh, one of our financial wealth management advisors. He comes to us with 28 years of experience, a wealth of knowledge, and I can let him tell you a little bit more about himself if he wants to, but with that, I'm just going to hand over the reins to Jimmy. Thanks, Jimmy.
Okay, thank you so much. So good afternoon, everyone. And today we're going to be talking about my wonderful topic called Investing 101. And feel free to make this as interactive as possible because the purpose of this is really to provide you with education, knowledge, and information. So it should really be a benefit for you for the next 45 minutes. So basically, the 5 things we're going to be talking about today with the basics of investments is why do we invest? What are the basics? What is this thing called a mutual fund or ETF? What is asset allocation? And why should we start considering investing today? So those are going to be the 5 topics. So the first question is, why do we invest? When we plan for an investment or financial plan for the members of the credit union, really you have to have goals behind it. And we may have these several different goals, such as maybe buying a house, paying for our tuition for our children's education, our grandchildren's education, or even looking to save for the long-term retirement. And in that sense, everything that we do with investments has to be tied into a goal. Without a goal, the investments loses focus. So just to give you an idea about what are some of the characteristics about why we want to invest is that when you're looking at investments, over time, the growth in investments has the highest appreciation compared to any other asset classes. And I'm going to be going into what the asset classes looks like. Here's an example looking at from 1966 until 2016, just to give you a brief idea, what a $10,000 investment would have grown over time if you invested into what they call the S&P 500. If you notice about this growth rate, it has these ups and downs, which we'll be covering in about 3 slides from now, but investments have some sort of risk, and I'll be talking about the risk also. Now, the question is the investment basics. Well, sometimes the members in the credit union will say, you know, I could invest into a CD, and it gives me the highest level of safety, so therefore, isn't that kind of one type of investments? Yes. In the investment area, there's actually 3 types of assets. But if you look at a CD rate, just as an example, the blue line here kind of shows us what the CD rates has been since 1997 until now. So back in the late 1990s, CD rates was offering about a 6% rate of return. And then early 2000, it pretty much went down to 2% and went back up in 2005 to a high 4 to 5% rate of return. The one thing to keep in mind with any type of investments, for example, like CDs, is that what's the impact after taxes and after inflation? So inflation is one of the big topics that we're constantly talking about today, hitting about 5% inflation rate right now, but taxes have to be consideration. So if you take out the taxes and inflation in a CD type of investment, you're going to notice the green line. And in the beginning of 2000 or the end of 1990s, CD rates was at least getting a positive rate of return after inflation and after taxes. But after 2000, and especially after the 2008 financial crisis, the after-tax returns, inflation returns became negative. So if CD is used to be one time a good location to go into for conservative investments, but after 2008, it is not the best place when you consider inflation and taxes. So the question is, where could I go into to invest at that point? And this is where we're going to be talking about investments 101. The three main asset classes that's out there for investments is one called stocks, one called bonds, and money market or cash position. Cash is typically where we consider like savings or checking account, and ideally you want to keep anywhere between 3 to 6 months worth of cash reserve on monthly expenses sitting in a money market cash position. Stocks on this side, which is the blue box here, stocks is a way that you could have ownership in a company directly or indirectly on the performance of that company. Bonds, on the other hand, is basically it's like a loan. You're loaning a company money, and in return, they're going to be giving you back interest on a quarterly or semi-annual basis at that time. So before I go into a little bit more detail on this, let me kind of give you an example. So let's say, for example, today you decided to open up a lemonade stand. When you invest into a stock at a lemonade stand, based upon the performance of how many lemonades that we sell, that's how the performance of that lemonade stand does. Bonds, on the other hand, is like you're giving them a loan, and in return, they're going to be giving you interest payments every 6 months or sometimes every 3 months, and that's the bond category. A good example now that I could think of is just yesterday I was looking at this. Apple stocks is a stock category. So far, year to date is up about 12%. If you decide to buy an Apple bond, it's paying out roughly about 1.7% for a 10-year Apple bond. So every U.S. corporation, publicly traded company, both issues stocks and bonds. So you could either have stocks of ownership or bonds if you want to get interest from those type of investments. And lastly, the money market account is for like day-to-day usage. And feel free in the Q&A if you have any questions on what I just mentioned about the three asset classes. Okay. This is kind of getting an example of what the performance of those things has done. So if you notice about the stocks, it has its ups and downs. So $10,000 invested back in 1996, 10 years later would have grown to about $40,000. Bonds would have grown to about $28,000. A 6-month CD would have grown to 17, and a 3-month T-bill about 15. Along the way, a lot of times members and clients will ask, how do I invest into these stocks without the risk of it? How do I invest into bonds and choose the right bonds in my portfolio without the risk? But I like the idea of the stability of the 6-month CD and 3-month CD, but it's very stable and flat at that point. Is there a way to invest as a beginner into investments? And the one way that was created was something called a mutual fund. Mutual funds were created in the early 1900s, and a mutual fund is basically, in a nutshell, it's a pool of money where you could participate into a stock mutual fund, a bond mutual fund, or money market mutual fund, or cash mutual funds, where you don't have as much risk of buying individual securities because it is spread out. Some of the benefits about this is that you have a money manager, it's pooled with other assets, and you're able to access some of the investments without going into individual securities or bonds at that point. Keep in mind, from a compliance point of view, that anytime you do invest into a mutual fund, you do have to get a copy of what they call the prospectus. In the prospectus, the thing that I would highlight here on this list is that look at the investment objectives and goals. Each mutual fund, indirectly or directly, is actually a separate company. And in that company, they have to state the objective of the mutual fund, whether the mutual fund is a large cap growth, whether it's an international investment, whether it's a bond mutual fund, and the money manager has to keep with the same strategy regardless of the financial situation in the market. The other thing to keep in mind is that on page 7 or 8, typically in every prospectus, they talk about the fees and expenses. So, you want to look at to see what the internal expenses are, and then it talks about the highlights and the performances in the prospectus. Now, as I was mentioning before, the biggest advantage about a mutual fund and investing is that you're able to go into an investment, diversify your investments. So this way, you're not at risk of individual stocks or bonds. You're able to have a money manager who's managing the portfolio for you. And It also provides you with an affordability. In the sense of affordability, is that in the past, we would always recommend a client to buy at least 100 shares of XYZ stock or $10,000 of XYZ bond. By going into mutual funds, some mutual fund has a low requirement, and you could invest as low as $1,000 into a mutual fund or $50 a month if you go on what they call a periodic savings plan. The other big benefit of our mutual fund is that it provides you with liquidity. What that means is that if you ever need the money in the mutual fund, it takes anywhere between 3 to 5 business days before the assets are back into your bank account or your credit union at that time. So therefore, it gives you this liquidity, even though we advise whenever you invest for the long term, 3 to 5 years plus time period. They do give you the option of being able to take the money out if you have an emergency in a family situation. We're going to be kind of going into the risk as we go into each individual mutual funds later on, but the three main factors that today is going to be talking about is principal risk, interest rate risk, and foreign investment risk. So let's first talk about stock fund investing. When you invest into mutual funds in the stock mutual fund category, there's actually going to be three other subcategories of that investment. We have what they call growth funds, valued funds, and then what they call sector funds. So the best way to explain the difference between growth funds and value funds is that I kind of like to use this example of driving an automobile. If you're driving a car and you're looking forward out of your windshield, looking out 1/4 or half a mile down the road at that time, you're looking toward the future. Growth funds are looking to the future, looking forward down your windshield at that time. Growth companies are always looking to see what is the predictions or the forecasting of the next quarter, next year, next 3 years, and based upon what the future may hold, growth companies is priced based upon the current profitability as well as future forecasting. Valued companies is the opposite. So as you're driving down the car and you're looking through your rearview mirror and you're looking back where you came from, that's kind of what the value company is. Value companies look backwards. They look at what the last 5 years balance sheet has been, what the last 5 years income and expenses has been, what the last 5 years ratios has been in profitability, and based upon the past performance, they're kind of looking at future predictions of that value companies. So a good example of a growth company would be like technology companies, pharmaceutical companies. If you notice these companies, they have to always be looking forward, new product development, new research development to come up with new types of product or services to keep the price of the companies to go upward swings. So imagine one day, let's use Apple for just an example's sake. Imagine Apple today announced that they have let go of everyone in research development. They're not going to create any new iPhones or iPads or iComputers for the next 20 years. And whatever the current phone that they have is going to be the way it is. What do you think is going to happen with a growth company like Apple if they make those announcements? It probably won't do well. Value companies, on the other hand, is the opposite. A good example of a value company, I would say, would be like International Paper or paper companies. When's the last time you've seen any type of technology improvements in paper? Paper is pretty much standardized for the last 200 plus years, and no one has really come up yet with a new technology of how to create paper. But paper will be a value company, like lumber, timber, or oil, gas. They're kind of more of a value-oriented than it is growth-oriented. Now, sometimes they will go back and forth. Sometimes a growth company will become value will become growth. And then the last thing here with the stock investment is sector funds. Sometimes individual investors will like to go into what they call individual industries, where they want to go into technology industry only or pharmaceutical industries. Be careful with sector funds because they come in and out of favor in any given quarter based upon the economic situation. So ideally speak to your financial advisor and therefore let us design the right portfolio based upon your risk tolerance for the stock investments. So again, any questions, feel free. Bond investments. Bond investments is that second category, which is similar to getting an interest or it's kind of like giving a loan to a company at that time. And in the bond category, there are three different categories also that I want to highlight. Taxable bonds, tax-free bonds, and the last thing I want to talk about is the risk associated with these bonds, which is called interest rate risk at that point. In the bond category, based upon your tax bracket, the advisor will be able to recommend either a taxable bond portfolio where the interest rate will be a little bit higher, but you're paying taxes on, or you could go into tax-free bonds where because you're in a high income tax bracket, your interest itself can be up to triple tax-free, such as federal, city, and state taxes, or it could be just dual tax-free. So based upon what state you buy these bonds into, if you're living in the state and you're buying that state, it could become tax-free versus if you buy treasury bonds where it's federal exempt. So there are different types of taxable, tax-free. And the question may come up is, which one is better for me? This is where it all depends upon the interest rate environment and which state you're living in, and to see which yield is giving the highest yield, taxable or tax-free. The one risk about bond investments, similar to stocks where have market fluctuation, is that it is very sensitive to interest rates. So as interest rates goes up, typically, not all the time, but typically the bond prices will go down. And when the interest rates comes down, the bond prices will go up. So that's what they call a negative relationship between the two. And the question right now that everyone's asking is, do you see interest rates going up, staying the same, or going down? And the prediction is that the interest rate most likely will be going up. If so, we have to be careful with the bond mutual fund investment so that we don't lose our principal value in the bond mutual funds. And there are things that we can do to offset that as well. But in bond investments, those are the two categories. Okay. The last category is going to be what they call the global fund investing. And the question that may come up sometimes from a lot of our clients is, why should I invest globally when I could just invest in the US companies? Here's kind of an interesting stat, and I'll show you what the stats is today in 2021. Back in 2016, if you look at the equity or the stock market, 54% was based upon US market cap versus the international, which was 46%. In the bond portion of it, US was 34%, and the foreign bonds is 66%. So there's more overseas than it is today. Going back into the stock market, if you go back to 1970, which is not in the slide right here, but if you go back to 1970, 80% was US capped and 20% was international. So over time, the international market, due to development with a lot of these other countries, has started to increasing the market cap versus the US. In 2021, I saw one other thing that came from Franklin Templeton, where US is now close to about 47, 45%, and the foreign market is increasing. In the bond market, however, we have also lost the market share. So if we don't invest globally, we could be missing out on about 2/3 of the opportunity that we're only being what they call country bias. We're only investing to US companies at this point versus overseas. Now, this is kind of giving an idea about some of the global investors that's out there. So all these countries in blue shows us that they're investing into other countries also. So it's not just us looking at global. Every country in the world is also looking at global investings, and some of them will become biased to their own country, or they'll buy US companies as well, and they're going back and forth. Now, let me show you then how it has performed over time. So this chart is showing us the best performing stocks and the best performing bonds over this 10-year time period. So if you look at the stock category, which is this category right here, if you were only invested into US companies, hypothetically back in 2007, 2008, 2009, et cetera, at that time, we may be missing out where Finland was the #1 or the best performing stocks in that year. Then it was Japan, then Norway, then Sweden. If you look at this list in this 10-year time period, US is not on the top 10 or even the #1 country in the equity portion during the same time period. In the bond market, if you look at the performance of bonds, US was not represented here. The point of this example I want to show is that there are other opportunities in other countries versus US, and that's where the foreign risk comes into place, that when you design your portfolio for your mutual funds, consider both US and international stocks and bond mutual funds and money market cash mutual funds, so you can create a balanced portfolio so that you're minimizing the risk as much as possible, but trying to maximize the return after taxes, after inflation. You may have heard something called asset allocation. And here I'm going to pause to see if there's any questions. Okay, no. So here's something called asset allocation. What is asset allocation? Asset allocation was created to help diversify your portfolio between these three different asset classes to minimize the risk and maximize the return. When asset allocation first came out back in the late and early 80s, at that time, there was three asset classes, which is called stocks, bonds, and cash. Now it's got diversified to what they call alternative investments and other types of sources. But to give you an idea, asset allocation is having your money invested into different asset category, typically the stocks, bonds, and cash, so that your portfolio is well diversified. And by having it well diversified, you're going to minimize the losses. The one thing that's interesting about an endowment fund or pension fund is that when they invest the monies in these funds, rate of return is the last category they look at. The first category they look at is managing the risk. If they manage the risk, the performance actually comes in. And this is a little bit different than, I would say, a new investor, where a new investor will look at how do I get the maximum return on your portfolio? That should be the last question. The first question should be, based upon the risk, how do I minimize the risk so therefore I could get the highest return? And I kind of want to show you an example of this. And the next slide is going to be a little bit confusing. We call this the periodic table. It may not be as clear on your screen, but basically this is showing us a stack ranking every year of who was the top performing and the low performing. The slide can't show you correctly, but if you look at just the colors, each color represents a different asset category. So the blue would be considered as bonds, the orange would be considered large cap growth. And it shows you that in any given time period, if you look at these slides, the top performing in one year could become the bottom performing the year after. The bottom performing in those years could become the top performing the next year. In other words, no one can predict the future, not a portfolio manager or financial advisor, because the future is unpredictable. So the best way to minimize those type of risk is to making sure it's diversified between stocks and bonds. So this way you're getting a nice average rate of return over your portfolio. So that's kind of the benefit about having it diversified with asset allocation. Kind of a quote from one of the founders of the Templeton Mutual Fund, and there was one of the four first mutual funds created in the United States, and he basically says that history shows that time, not timing, is the key to investing success. So we're going to be talking about how we're going to have investment success once we go into these mutual fund investments. And here's an example. That sometimes we'll say, Jim, I think right now the market's really too high. I'm a little concerned about the market. You know what? Let me just put everything into cash and wait. So let's assume right here that you had $10,000 to invest on the best day of the year and the worst day of the year. And this is looking at a 20-year time horizon. So if you did $10,000 per year for 20 years, you're looking at $200,000 being invested. If you invested on the best day possible, your rate of return will be about 8%, which is roughly about $528,000 over 20 years growth rate. If you invested in the worst day possible, the day that nobody wants to invest at that time, your $200,000 would have grown to about $399,000 or $400,000 with a rate of return of 6%. In other words, if you try to time the market and trying to find the best day or the worst day of a 20 years time horizon, the difference between the performance is anywhere between 2%, give or take. It's between 8% or 6%. It is still better, and keeping the money in cash, where the cash was not averaging 6% of return for the last 20 years. So this is kind of giving an example. Be careful of timing the market or waiting and procrastinating to put it on the side, but have it invested and invested over time. One of the philosophies that we use, especially for very risk-averse clients and members, is something called dollar cost averaging. And you may have heard about this philosophy or strategy, but this strategy is basically where we put in a systematic same dollar amount every month at the same exact time into the investments versus putting a lump sum. So sometimes a client or member will come up to us and say, you know what, I want to put $2,000 into my mutual fund and let's see how it goes. But I'm very concerned about risk. This is where we can let the client know or the member know, instead of putting it in on $2,000 lump sum, what if we did it every month, $500, like the first of the month, and based upon whatever the share price is at that time, we're going to be buying the shares at that point. Now, if the price of the share is low, you acquire more shares. So when you're investing into mutual funds, your dollar amount is actually buying the shares of that mutual fund. So based upon the price of that mutual fund, that's the number of shares you receive. So if it's $8.50 as a share, and you're putting $500 in, you acquired 58 shares. Versus, let's say next month it went up to $10, you acquired 50 shares from the same $500. The next month it went down to $43. I'm sorry, it went up to $11.50. So you acquired less shares of 53 shares, and went back down to $10, which is 50 shares. Over time, because you're dollar cost averaging, on average, you receive about 1.1 to 2% less price versus if you decide to do a lump sum of $2,000 initially by dollar cost averaging. The reason why this works is that the assumption we make is that the market will go up and down, up and down. If you know that the market is a straight line up, then it makes more sense to do the lump sum of $2,000 from day one. But because we know the market goes up and down like this, by dollar cost averaging, you're actually buying shares every month, more when the price is down, less when the price goes up. And this is what they call dollar cost averaging strategy. Any questions on this, or if you need more examples, feel free to reach out to us afterwards. This is kind of showing us what a growth rate would be for $10,000 based upon different rates of return. And when we tell members that you're going to get a 7% rate of return, it doesn't create this like wow factor, like 7%, okay. But over time, if you look at 20 years, $10,000 invested with a 7% return went to close to about $38,000, which is about 4 times the amount with a 7% return. At 11% return, which is about 4% increase, that same $10,000 was able to go to $80,000. So in other words, by having 1% or 2% increase in returns makes a significant impact over time because of the compounding effect. This is kind of the reason why I want to show this slide is that every percent counts, every dollar counts. So in this note, 5 points to remember as a kind of a recap. Why do we want to invest? To invest for your goals. What's the basics of investments again? You have stock mutual funds, bond mutual funds, and cash. What is a mutual fund? Pool of dollars professionally managed. What's asset allocation? Diversifying between the different asset classes to minimize the risk as possible. And now, why should we invest now? And the reason why we want to invest now is, oops, 1 second. I think this slide is a little bit out. Okay. Oh, okay. Never mind. So here is the last slide, which is we really want to set up an appointment with any of the advisors in the location. And there's a little picture of who I am, but we have 2 other fantastic advisors. Michael Toy is in the Cupertino and the Mita Pas, sorry, my pronunciation branch. Eaton is in the Bowers, the Dubai, the Boke, sorry, my pronunciation there. And I'm in the Goleta location. So if you have any questions about anything that we covered today's presentation, feel free to reach out to Mona. Mona is an assistant, an associate, and that is a contact information with an email and a direct phone number as well. So here, let me pause to see if anyone have any questions. Jillian, thank you. Will a financial planner help someone decide which mutual funds they should invest into? Yes. So the question is, can the financial planner help you decide? Yes. So the answer is that we go through a financial planning process. And the first meeting when you sit down with ourselves is basically we want to know what your goals are, what your risk tolerance is, which we go through what they call a riskalyzer. That kind of gives us an idea. And then based upon what your goals are, your time period, our goal is to make the recommendation to which portfolio to be invested into. Now, there's 3 categories or 3 metrics that we have to meet before you invest into any type of investments. 1, you have to be comfortable with it. If you're not comfortable with it, let us know because we need to make sure that you understand it fully. 2, you have to understand it. And 3, you have to agree with it. So in those step meetings that we have, either 2 or 3 meeting process, we will sit down with you and let you know what the investment is, how it works, answer your questions, and then we want to make sure you're comfortable, you understand it, and this is what you agree upon, and then we'll make the recommendation and we'll assist you in opening up the accounts for you and implementing and investing it for you. How much cash should someone have to begin to investments? So, good question. It all depends upon each individual situations, but typically when we sit down with the members of the credit union, we want to first make sure that you have your cash reserve taken care of. So whatever your monthly expenses are, let's say you spend $5,000 a month in expenses, keep at least 3 to 6 months worth of cash reserve in the bank at all times for day-to-day spending and emergencies. So that's kind of the first thing you want to look at. If you're a small business owner, we recommend a higher cash reserve because small business owners have more fluctuations than individual employees. The second thing to keep in mind is that if you have any short-term debts, like credit card debts, et cetera, that's paying a high interest rate, you should pay off those things first before you invest. So first thing is have the cash reserve. Second thing is pay off the short-term debt first. The excess amount at that point, that's the portion that if you have a time period of 3 to 5 years, that's the portion you should consider investing. Now, you may ask the question, Julian, what if it's only $50 or $100? Is it worth investing? If there's a mutual fund investment that starts off at $1,000 or $500, it is absolutely worth it because in finance class back in the old days, I remember the compounding impact effect where they said if you had 1 penny and you invested and you increased the penny every month by another penny and you increased it and got a 7% return, your portfolio balance after 10 years was X amount of dollars. It's not the fact that the dollar amount to invest, honestly, it's the habit of saving for your financial goals that's more critical than anything else. And when you're trying to achieve your financial goals, you should start off with anything as little as $10, $15, but it's a process of saving for that. That's kind of what I would recommend if that kind of answers your question. Next question, anonymous attendees. What's your view on cryptocurrency as an investment? So great question, cannot comment because Securities America as well as PhD advisors, our internal compliance department has stated to us until we could offer cryptocurrencies to our members, we cannot comment about it. So I could give you my personal opinion, but at this point in the seminar, I cannot comment about cryptocurrencies. So sorry about that for anonymous attendee. Any other questions that I can answer for you?
This is your chance to pick Jimmy's brain.
Wow.
Oh, you got
33 minutes. Let's book.
Looks like you have another question that just came in.
Okay. What is your view on ETF versus mutual funds? Okay. So great question on that one, anonymous attendee. So mutual funds, as you know, started out back in around the first mutual fund was actually around 1894 by a company called Putnam and MFS. But afterwards, mutual funds started created, it got popular back in the 1970s. So before 1970s, there was less than 100 mutual funds. After 1970s, it exploded with all these mutual funds, and now we have about, give or take, the last count I think is about 38,000 mutual funds at that point. ETF was created about maybe 20 years or so, give or take ago. And the reason why ETF was created is that ETF was trying to become version 2.0 of mutual funds. In the mutual funds, the biggest complaint that we had on our mutual funds is that at the end of every year, even though you didn't sell the mutual funds, you got this thing called capital gains and dividend taxable event for tax purposes at the end of the year. And a lot of people would ask, why am I getting this even though I didn't sell my mutual funds? Because within the mutual fund itself, professionally managed, they're buying and selling the securities every day to minimize risk and maximize gains. And every time they sell it, it creates a taxable event. The ETF does not have that taxable event. So in that sense, an ETF is a little bit more tax sensitive or tax responsible than a mutual fund setting is at that point. The second thing that was kind of a deviation or a concern about mutual funds is that you couldn't sell a mutual fund until the end of the day of the closing of the market. So ETF, again, which I call like mutual fund 2.0 version, ETF was created because ETF acts like a security, which means that you could literally sell it at any given time during the trading day. So therefore, you get priced at that point, and then it's closed, and therefore you have the capturing of what the price of that mutual fund may be, or the ETF would be, instead of waiting for the end of the day to see what the price is. So there are benefits to both mutual funds and ETFs. ETF become more of a version 2.0 version of it, where there's some benefits about the ETF once, especially when you have a higher investment assets. But if you have an investment assets, let's say, for example, on the lowest scale of anywhere below $100,000, mutual fund, because it's professionally managed, it's diversified, is a better fit than an ETF. Once you get above $100,000, $200,000, then the ETF has a little bit more benefits than the mutual funds, especially with the tax savings or the tax sensitivity at that point on. So therefore, the ETF has its benefits there. And eventually, when you get above $250,000, then the individual securities with a professional management makes a little bit more sense from a tax point of view at that point. So, in other words, each one of them has its benefits: a mutual fund, ETFs, professionally separate money managed account like individual securities. Each one of them has its own positive and negatives. So before you invest into ETF or mutual funds, sit down with one of the advisors, myself, and then we could give you the pros and cons. And based upon your situation, we can make the best recommendation and tell you the reasons behind it. Sorry, that was kind of a long-winded answer to that question. Okay.
I think there's another question in there for you, Jimmy.
Oops, there it goes. Can you review a money market again? Oh, yes. Okay. So let me go back into this screen here. Money market accounts. So out of the three asset classes, stocks we know is the ownership, bonds we know is the loans, money market account. A money market account is actually is a mutual fund buying short-term securities that has daily liquidities to it. So it's kind of like if you look at a cash account, the first account that most people open up is a checking account so that they could write bills and expenses at that point on. The second account that would open up would be a savings account because they don't want to keep too much money in the checking account because it doesn't provide interest. So they will move the money into a savings account to get a little bit higher return, and they use that as the second bucket of savings. Then the third bucket would be like a money market account. Sometimes they will open up a money market account to get a higher rate of return than a savings account. Now keep in mind, the savings account in the credit union is insured. The money market account is not insured because it's indirectly considered as a short-term cash investment account. So therefore, money market, from our opinion though, a money market checking and savings account, we all classify them as a cash account. And a cash account to us is money available for you to spend to day-to-day expenses and to have the money available for emergency purposes only. And, if you think about it, before 1970s or 1980s, when, credit unions and banks used to give out free toast ovens when you open an account, typically the cash account was really there just for 0% interest and just to be able to use the money to spend for expenses. It's only over the last, I would say, 30 to 40 years that we started giving interest in bank accounts. And the reason for that is because we realized that we want to give the members interest on their cash reserve accounts. But whatever that account is, it's really for day-to-day spending. It's not for investments. If that kind of makes sense for the money market account. I hope that answers your question. Oh, we got one from the chat room too. What's this chat? Nando asked the question, would we have access to the slide? As we stated earlier, it has to go to the compliance review, but you do have access to the recorded presentations on the website at KeyPoint as well. But I do not know once compliance reviews the slides. Oh, okay, good. Thank you, Mona, for responding to that.